morning and thank you for joining us on the program. I am BC Adebayo. We'll kick off with the latest regarding oil prices, which were struggling to hold on to 5-month highs reached in the previous session as fuel demand worries caused by a second wave of coronavirus infections outweighed declines in the US dollar. Brent crude futures rose 6 cents to $45.23 a barrel, while US WTI crude futures were down 3 cents at $42.16 a barrel. The two benchmark contracts rose more than 1% on Wednesday to their highest since March the 6th, completing a 4-day rally after the Energy Information Administration reported a much bigger than expected drop in U.S. crude stockpiles. The EIA data showed distillate stockpiles, which include diesel and heating oil, climbed to a 38-year high, and gasoline inventories unexpectedly rose for a second week in a row. Of course, we'll talk more about oil prices in our commodities market updates still ahead. But now it's still earnings season, and at the Nigerian equities markets, where unaudited financial statements of listed companies for the first half and the second quarter of 2020 have been showing dismal figures, except for a few firms which have been able to weather the storm with retained earnings. We'll shift our attention to the consumer space now to dissect and understand the performances of key breweries and one of two fast-moving consumer goods companies, and the head of portfolio management at Commercial Partners Asset Management Limited, Victor Aluyi, joins us now to analyze these figures. Good morning, Victor. Thanks for joining us on the program. Of course, more earnings came in this week. What are your views of the earnings in general?
I think earnings in general, particularly if you look at the consumer space, have been largely reflective of the significantly challenged macro environment. It is important actually to recall that even before we had the COVID-19 challenge, that the macro environment had been significantly challenged. Remember that, the economy was essentially on the mend from that, recession that we had seen in the better part of 2016 and 2017. So clearly, the results is just reflective of the challenge that we're seeing in the general macro environment.
Now, let's take a look at the food business in the consumer goods space. Nestle's half year 2020 shows that revenue and profit after tax declined by 0.6% and 16.8% year-on-year, respectively. How did the whole lockdown and the public health management concerns within the second quarter impact these earnings?
I think for Nestle, that top line movement can largely be described as sort of flat. But again, if you do a deep dive into the various segments, you would see that in the food segment we actually saw a growth of about 4%. However, in the beverage product segment, we saw a decline of about 7.1%, and that speaks to the fact that the lockdowns, the restriction on gatherings and celebrations and all of that for the better part of Q2 had a significant impact on that beverage product segment, specifically, particularly its water business, which is a significant contributor. So clearly that has significantly impacted Nestle's ability to grow top line. Suffice it to mention that Nestle has remained one of the top quality consumer names, but of course the COVID-19 challenge really hit it hard in Q2.
Well, how much do we know about the high-cost items pressures and its impact on the bottom line? The cost of sales, for example, jumped by as much as 5.7% to 80.2 billion naira.
Well, I mean, so clearly they're not pushing out the products or their products as quickly as they would like. They're also sourcing an increasing portion of raw materials locally. So also you still have a significant portion of that is imported as well. So all of that put together will certainly pressure that cost of sales number. So I think it's around the ability to continue to grow sales organically that would help to improve the situation going forward, particularly for Nestle.
But when you look at the food business within the period now, one would ask what went wrong, because this is a segment that contributes more than 60% to Nestle's total revenue, but it dipped by 2.5% to 86 billion naira, according to the figures we have.
Yeah, so like I said earlier, year on year, we saw a 4.1%, a 7.1% decline in the food segment. I think that is clearly reflective of the whole, COVID-19 challenge, really. Like I said earlier, even before COVID hit, the Nigerian consumer had been significantly pressured. The macro environment was essentially just trying to put up some sort of recovery. So we don't really expect to see any significant growth on that part of their revenue, particularly, again, because these are largely discretionary items. So when consumers are pressured, such items will certainly take a hit.
Now, anything to say, Victor, about its debt position that declined significantly by 55.7% after some 10 billion naira was settled in outstanding borrowings? Does that sound like a healthy balance sheet position to you?
Well, I think what would have led to that, like you said, finance costs rose to about 383 million from just about 3 million. Early on in the year, I think particularly in Q1, they had essentially paid down about 10.3 billion in borrowings. But we saw some intercompany loan in Q2, about 5.8 billion. I think that was probably taken out to help with working capital needs. So that is the reason we saw that spike in finance cost. I want to believe that as the COVID-19 situation and the general macro conditions improve, they will be able to pay that down, and then the impact of that on their earnings and bottom line will be muted going forward.
So with the earnings now, what's your outlook for Nestle for the rest of the year?
I mean, Nestle still remains a resilient consumer name, has, top products in all the various segments that it serves. So I believe that it will continue to remain resilient. However, the broad macro headwinds that we face specifically as a country and the COVID-19 challenge that the entire global economy faces will continue to put a lead on, how much they can grow revenue, at least in the short to medium term. However, in the long term, I think they would do well and recover quite strongly.
All right, Victor, now let's talk about Unilever. The 35% decline in revenue to 27 billion naira in the half-year 2020 result is quite worrisome, you'd agree. Tell us what's going on with that food major.
Well, I think Unilever has been challenged for some time now, moving from challenges with respect to balance sheets, and then, of course, deeping into the recession, and then the COVID-19 challenge that we're also seeing. If you dimension that revenue into the various segments, that's the home and personal care, home and personal care, and also food products. Home and personal care revenue was down by about 45%. Food products revenue was down by about 35%. And this is actually marking like a seventh consecutive year-on-year quarterly decline in revenue. So Unilever has been significantly challenged. You have a lot of other products that, consumers can easily trade down to, particularly as, the economic situation even becomes tougher. So clearly it would be a struggle, to push their products out there and also to grow top line, particularly in the economic situation that we find ourselves in. Unless we begin to see some quick improvements in the economic situation, I think that Unilever will continue to remain pressured.
But then there appears to have been some mild improvements on a quarter-on-quarter basis when you look at the food and the HPC segment's performance that grew by 5.9% and 4% apiece. Does the reintroduction of the single cube seasoning have anything to do with that quarterly growth?
Well, at the time, initially it did. But again, I think all of that then sort of dovetailed or cascaded into the whole economic challenge that we're seeing now. And that is pretty telling on the results that we have seen, particularly for H1. So I think, its major segments would really remain under pressure. The home and personal care and also the food, a lot of these are largely discretionary. And you have a lot of alternatives, cheaper alternatives in the market. So you would expect that as consumers are pressured, they would likely trade down to those other cheaper alternatives. And that would just continue to put pressure on Unilever's ability to grow those sales numbers, at least in the near to the medium term.
But Victor, if you look further at the gross margin, you'll notice a significantly weaker 4.1% year-on-year figure. What role did the cost of sales and the cost of operations play here?
Well, so you saw significant growth in those cost of sales number. Essentially, growing quicker. Not as quick as the decline that we saw in revenue. So clearly there are cost pressures there. Particularly again with respect to the sort of environment that we find ourselves in, that continue to pressure operational efficiency as far as things go for Unilever. So I think that there has to be some drastic moves to try and create a bit more efficiency around those cost of sales numbers, such that bottom line would remain healthy, even if there's still a struggle to grow revenues.
Just yesterday, the parent company of Unilever announced the sale of the tea-making business. Any idea what is fueling that decision?
Well, it's not so clear yet, and we're not totally certain how that would impact the numbers. Clearly, I believe that there's some, efficiency drive going on. The company is basically looking to re-strategize and realign its product portfolio to stay nimble and to stay efficient, really. So I think those are some of the, reasons for that. But again, the impact for us really remains to be seen.
Last year, Unilever amended its receivables policy, and then we saw the impacts on the half year 2019. What does that tell you about the company's path to recovery?
Well, so in terms of that policy, it didn't quite augur well at the time, because it essentially kept a lot of cash out of the business and also, stunted those revenue growth at least for that. Second half of the year. But I think that what the company continues to try to do is to figure out ways to push out its products as quickly and as much as it can. Continue to create efficiencies along its route to market strategy. So I think these are issues and things that the company will continue to focus on and see how they can improve on those going forward.
But do you have any further forward guidance on Unilever for the second half of 2020?
I think the second half for Unilever and really just any other consumer player would largely hinge on, the broad macro recovery that we see, the sort of traction or improvement that we see on the COVID-19 front. All of that will certainly act significantly to affect the performance. Like we've seen, these results are essentially laced with strong signs of the COVID-19 challenge, and also the fact that the Nigerian consumer had even been pressured significantly challenged even before the COVID-19 situation hit. So clearly going forward, how the macroeconomy improves, how the COVID-19 situation gets on would significantly impact, these consumer players.
Now let's switch to Nigerian Breweries, which seems to be at the receiving end of the restrictions in social gatherings and, of course, the ban on clubs and bars during the lockdown as volume growth declined since March. Tell us how this reflected in the earnings.
Well, so for Nigerian Breweries, revenue was down about 21% year on year. So that dip in revenue, again, is clearly reflective of the lockdowns that we have seen, particularly in major beer markets like Lagos, Abuja, and in Oyo as well. So the restriction of gatherings in bars, in clubs, events like weddings and all of that has obviously had a significant, impact. If you look at gross margins, it declined by about 6.8% to 35.4%. If you even dip further into those margin numbers, you will see that, raw material costs actually declined a little bit, but other expenses really could not offset that impact of decline in raw material. So clearly, margins still seem quite pressured. If you look at, the finance cost, that actually significantly grew by about 65% to about 4 billion. And that was as a result of the fact that the company recorded higher bank overdraft and short-term loans. That went up by about 85%. So financing is becoming some sort of pressure. And that was also responsible for the sort of result that we saw. On a positive note, and which is largely expected, we saw a reduction in marketing and distribution expenses because, of course, there were those restrictions. So clearly, you didn't see a lot of marketing, going on. But I think one, strong spot again for Nigerian Breweries is, its cash balance. We saw its cash balance increase by over threefold to about 54 billion. So that's really strong for them. But I think that, for Nigerian Breweries going forward, the easing of lockdowns should bode well for them. And that should actually lead to an increase in selling and distribution expenses and also promotional expenses. So it really remains to be seen what sort of efficiencies that they are, going to try and, get out, particularly with respect to spending on promotions and also pushing their products out, particularly seeing the lackluster growth that we have seen, particularly in Q2 as a result of the restrictions.
But while we wait to see how that pans out now, of course, Nigerian Breweries is quite a diversified company with variants of non-alcoholic drinks. What do you make of the patronage of such products, especially at states where alcoholic drinks remain banned?
Well, I mean, the truth of the matter is that these are still largely consumer goods. As long as you have macro challenges, as long as consumers are pressured or are challenged, you will see those numbers reflect clearly in any major consumer player, particularly when you have these kind of stringent economic situations. It will clearly reflect whether it's alcoholic or non-alcoholic. You have significant restrictions that don't allow gatherings, and the, if you will, the sort of drinking culture in Nigeria is not the type that people buy drinks and take at home. We essentially kind of go out to hang out and drink. So if there are restrictions on those outings, on those events, it will certainly have a significant impact on revenue for Nigerian breweries.
Well, then there's a high cost of finance and input costs, both of which worsens the bottom line. Anything to say about that?
Well, like I said about the finance cost, you saw about an 85% growth in bank overdraft and short-term loans. So that clearly shot up finance cost. Interestingly, for Nigerian breweries, we really haven't seen any strong impact of the slight currency adjustments, particularly for margins. And I think, the continued sourcing of local raw materials has probably helped to assuage that. But I also believe that going into Q3 and probably the rest of the year, we are likely to see that impact show through the finance cost and also in bottom line.
Then how commending is the decline in the cost of sales, which dropped by 60% year on year to 92 billion naira?
I think that is probably reflective of the slowdown in activity, really, because once you see that sort of drop in revenue, clearly you would expect cost of sales to also follow suit. So I think it is reflective of, the slowdown generally. However, I think it is also commendable that, that slowdown in cost of sales is, significantly more than the reduction that you are seeing in sales or in revenue. So I think there are some efficiency gains there. But again, it just speaks to the fact that things have slowed down quite significantly.
So any outlook for the company in the third quarter?
I mean, Nigerian Breweries remains the major player within that sector. Like you mentioned earlier, it's got a very, very diversified product portfolio. And that's the reason that they have remained as resilient as they have been. I expect that they will continue to be resilient even in the face of these economic challenges. Suffice it to say that I think that things would improve from here on out. It's important to note that Q2 essentially heralded the period of the, if you will, this most stringent set of lockdowns. As these lockdowns start to ease and we begin to see such gatherings again, that should bode well for Nigerian breweries and should help sales and overall performance really going forward.
Now, just before I let you go, Victor, talk to us about international breweries. Beyond the lockdown order in the second quarter, is the surge in other expense line item, some analysts believe that is that this is as a result of net FX loss. Is this your view as well?
Well, I haven't seen, those FX loss translate really, particularly in terms of, the margins. But I mean, I can speak to the fact that we saw about a double-digit decline in volumes. Of course, again, this lockdown has significantly impacted the ability to grow volumes. And this actually marks one of the biggest declines in volume since that merger in 2017. So clearly, international breweries remain significantly challenged. Its product portfolio appeals more to the value segments, if you will, where we expect a lot of consumers to trade down to. But again, I think that the entire value chain is challenged at this time, given the broad macro issues that the average consumer faces. So it's pretty much going to be the same story what you have for general consumers, and even more specifically for a player like Nigerian Breweries. I just feel like Nigerian Breweries has a more robust product portfolio and would show a bit more resilience than other brewers would.
Head of Portfolio Management at Commercial Partners Asset Management Limited, Victor Alui, thanks for speaking with us this morning.
Thank you for having me.
Our commodities market update will be up next when we return in just a moment. Don't go away. Welcome back. Time now to discuss the latest burning economic issues concerning the domestic commodities market. And a research analyst at the financial derivatives company, Nosike Nwajide, joins us for that. Good morning, Nosike. Thanks for coming on the program.
Morning.
Well, let's begin our conversation with the latest development at the crude oil market. Of course, we've seen Brent crude trading around $45 per barrel on sliding U.S. stockpiles. Talk us through that.
Basically, the oil markets are essentially been looking for things to prop it up. Given that, seeing that oil demand recovery is stalling because of a resurgence in coronavirus cases. So if you see this, huge decline in U.S. stockpiles, it's a sign that, demand, there's still some demand. This is amid OPEC Plus restoring some of its supply that it took away months earlier. So the demand picture is somewhat shaky. But given this huge chunk in decline in inventories yesterday, last week, the market is interpreting it as, okay, demand is still a bit solid, even if supply is, we may be in for a glut in the coming weeks, given how the events unfold. But we feel 45 is a threshold that it's breached. It got up to 46 sometime intraday trading yesterday. But it's something that remains to see how market forces play out to keep it above 45, given all the factors that I've listed. For Nigeria, this is at a time where its production is even, supposed to compensate for cheating on its quota in earlier months. So in June, it produced about 1.5 million barrels. In July, it should be less. In August and September, it should be even lower. It's at the time where oil prices are rising and other OPEC members are increasing production. So some of the market share may be, under threat. All in all, obviously, it's good this is at a time where reserves have been falling slowly. So oil proceeds are somewhat, we're more sensitive to cuts in production than to cuts in prices. So we expect the lower production in the coming months to really impact our reserves.
All right, but where do you see oil prices? Do you see oil prices sustaining this, positive, this uptick in the coming days?
It remained above between 40, 41, 42 for several weeks. The average price in July was about 42. So breaching 45 is a bit of is remarkable in my opinion. But I see that depending on how things play out in the coming weeks, I see it trend lower to just above 40. So the market wants to see that the demand recovery hasn't really stalled. But if the coronavirus cases keep increasing and big consumers like the U.S., cities in the U.S. go back into lockdown, it might see a situation where it goes back below $40 a barrel.
Similarly now, Nosike, these are perhaps good times for gold dealers. Of course, we've seen gold surging to an all-time high of over $2 as economic recovery remains wobbly. What's driving the price movement?
Gold is regarded as a safe haven asset in the markets, really. So in this period of economic uncertainty, where there's a resurgence in coronavirus cases, even when as far back as late 2019, there's been this, it started in China, the global economy started to falter. So the volatility in markets and the uncertainty in the global economy, so people saw the price of gold rise as people bought a lot of the commodity. We've seen a situation where in advanced economies like the US, where yields are really low because the Fed has acted to cut rates to near zero. So the global economies are washed with liquidity, and there's a weaker dollar. So dollar has an inverse relationship with commodity prices, even oil. If you have a weaker dollar, it props up commodity prices. So that's helped to prop up gold. As the uncertainty lingers. We expect gold prices to surge even higher. We've seen some forecasts of gold even reaching $2,500 an ounce by end of year. Some say even sooner. But as long as the uncertainty lingers, as long as gold is regarded by many as a safe haven asset, because over time it insulates against inflation, it's steady and it's steadily rising. We expect gold prices to remain strong and traders to keep to be in high demand of this asset.
Now let's talk more about our external reserves. Of course, you touched on it earlier. Of course, we've continued to see a decline, and it's now below $35.8 billion. But what would happen now that the World Bank has postponed the meeting that was meant to have with Nigeria to deliberate on the loan request?
Okay, the meeting's been basically postponed because Nigeria, obviously, the World Bank gives you conditionalities that you have to meet for you to obtain a loan. This loan is $1.5 billion. Obtaining loans from the World Bank is long tenor and low interest rates, so it's really attractive, but they come with conditionalities. One of them is the exchange rate, reducing the multiple windows that we have, and around the IEFX rate. That was one conditionality. The other one was electricity tariffs becoming more cost reflective. Nigeria is basically failed to meet up with the two conditions. You keep stalling on, or keep kicking the can down the road for the electricity tariffs. And for the exchange rates, I think the CBN's framework is inflation targeting. If you have a devaluation or depreciation of the exchange rate, and if you want rates to converge, you'll probably converge somewhere around slightly above 400. And that would lead to, even if it's close to about 474 at the parallel market, but that would lead to increase in price of imports, which would reflect in inflation, and inflation might soar to close to 18-19%, as we saw 4 years ago. So that might be heavy on the CBN's mind. So it hasn't really, it's not really, it's looking like it's basically holding out to see if the World Bank would change its mind. World Bank hasn't changed its mind. It's stuck to its terms, and Nigeria doesn't seem to be yielding, so to speak. So it's basically the meeting it has for today and tomorrow. It's left it till, let's push it to September to see if the Nigerian, central bank and the government are ready to meet these conditionalities. The impact is that the loan was for 1.5 billion. That would have added to reserves and taking some pressure off the exchange rate, because the perception that the reserves have been steadily going downwards. And foreign investors keep a keen eye on external reserves. So as it goes down, it's everyone, they're looking at themselves. Say, okay, is this when we exit? So another thing is basically you obtain these loans to carry out capital projects, or there's a huge fiscal deficit now that needs to be plugged. So if you don't get that, you might need to look elsewhere. Elsewhere might mean taking up loans at a higher cost, lower, shorter tenors, which, given the stretched fiscal situation, may not be the best option at the moment.
So does that put us in some sort of difficult position at the moment?
Yes, it does. Yes, it does. I mean, if I think in the first quarter of the year, our debt servicing costs were really high. So we're looking for ways to bring down that debt servicing cost. And one of the ways is taking long tenor loans that come at low interest rates, which is what the World Bank and the IMF offer you. So if you can get that from them, all well and good. If you can't, you need to even source domestically, issue even more treasury bills at higher costs. Right now, treasury bills are at 2-3%, but they might need to increase those rates to attract investment in treasury bills at this time. So it's a really shaky situation, which I'd like to see. Interesting to see how it plays out. Maybe they'll wait till September and see if they make some progress on the exchange rate and reducing the number of windows and the rates converging at the IEFX window.
We'll wait to see how that pans out. Now, the Naira, of course, has been stable at around 474 to the dollar at the parallel markets, and this is as the CBN continues to attempt to increase supply. Any idea how long we're likely to see this stability?
Well, it depends. When the CBN stopped its intervention early on, when the pandemic was wreaking havoc and oil prices were really low, oil prices were in the 20s. So, but now we're seeing oil prices rise. So the CBN has a bit more ammunition to intervene, as it were. So currently supplies about $100 million a week at the SMIS window as for importers. So we might see it attempt, to weigh things and attempt to supply a bit more, increase supply in the market and see how the events play out in the coming weeks. That's the one option it has at this point in time because, as you know, Nigeria's oil proceeds, as long as our production is trending lower, we hope that oil prices stay where they are or, not fall below 40 so that at least oil proceeds can be higher. Beyond that, its options are severely limited at this point in time.
Now let's talk about petrol price. Of course, yesterday the Petroleum Products Marketing Company increased the retail pump price for petrol for the month of August. What's the implication of all of this?
Well, it's something that would be the norm as long as the federal government has announced a complete removal of petroleum subsidy. So, given that we import most, if not all, of what we consume with regards to PMS, the prices would be reflective of movements in the exchange rate and movements in the global price of crude oil. Now, between June and July, the change, I think the average price in June for crude oil was $40, about $40 a barrel. In July, it was $42. So you have an increase of $2 a barrel. So I think that is reflective of the ex-depot price that's announced. We're hearing that as at today, or the price will be announced the pump price of petrol will be announced at about 148 naira 70 kobo thereabouts. I mean, it's expected. And in the coming weeks or months even, there was an exchange rate devaluation sometime in July. We expect that to reflect on prices, and the fact that the oil prices are around 45, 46 could be even higher. We hope that they remain higher. That will have an impact on fuel prices. Obviously, cost of transportation, if it might impede on aggregate demand, if people have to buy fuel and have less money for discretionary spending. So if you affect the price of fuel, the price of commodities, will probably the price of goods in the market as you take them from point A to point B will be higher, which will impact inflation.
Now let's talk more about the price of commodities now. Where are we in terms of pricing and demand?
Okay, it's the harvest season. So typically at this point, there's an inflow of commodities into the market. A major factor that is weighing on commodity market at the moment is it's a harvest season, but there's insecurity in parts of the north where most of these crops come from. So that might impede the harvest, and you have a limited amount of goods in the market, and prices will rise. There's also there's a partial reopening of schools, there's schools for those who are taking WAEC, and there's restaurants that will partially be open, and churches as well. So there's be some increased demand, limited demand, but increased all the same. So this would help prop up commodity prices in the coming weeks. But the major factor will be the increase in the price of fuel, which is logistics costs, as it gets from 143 to 148, 5 naira difference. But the transporters will probably increase their transport costs by much more.
So we're likely to see an increase in the price of
commodities in the coming weeks.
All right. Just before you go, is there any new development in the power sector that's worthy of note?
Not really. Well, we've seen an August break, so to speak. So the water constraints have been a bit higher than usual. Then the transmission, obviously, the losses in transmission are still the major constraint in the power sector. We saw power generation reach a peak or all-time high of over 5,000 megawatts sometime last week, but most of it was not all. Yeah, not all of it was able to be taken from point of generation to the distribution companies because of issues in electricity transmission. Until this is sorted out, then Nigeria can make headway in its power sector.
Research analyst at the FDC, Nosikin Wajide, thanks for coming on the program. We'll be back in just a moment. Please stay with us. Time to get a review of activities at Nigeria's equities market yesterday with Eddie Young Ewan. Good morning, Eddie. Reel the numbers through to us.
Good morning, BC. Well, I must confess, I am really excited about how the market has begun the month of August. The stock market yesterday sustained the bullish trend for the fourth consecutive session, with the all-share index rising 0.16% to 24,882.04 points. And this was following continued interest in banking sectors. We had some gains in GT Bank, Stanbic Bank.
All right, Adijong, we need to just sort out some issues there. But while we wait to get that sorted, let's just do a quick recap of oil prices, which were struggling to hold on to 5-month highs that were reached the previous session as fuel demand worries caused by a second wave of coronavirus infections outweighed declines in the U.S. dollar. Brent crude futures were up 6 cents at $45.23 a barrel, and U.S. WTI futures were down 3 cents at $42.16 a barrel. All right, it's back to you, Eddie.
Sorry about that break, BC. I was just talking about how excited I was about the way the market has started the month of August. Now, the stock market sustained its bearish streak for the 4th consecutive session yesterday, following continued interest in banking names. The all-share index rose 0.16% to 24,882.04 points. Now, the positive sentiments were largely driven by buying sentiment on Stanbic, GT, and Access Bank stocks. Total volume of trades grew by 148% to 382.28 million units, worth 3.89 billion naira, and all of that was traded in over 3,860 deals. UACN was the most traded stock by volume at 81.74 million units, while Presco was the most traded stock by value at 1.23 billion naira. Sectoral performance was broadly positive yesterday, as all the sectors we track were positive, apart from the insurance sector, which declined marginally by 0.01%. But joining me now to talk more about the equities market is Abdurrashid Momo, a stockbroker at TRW Stockbroker. Good morning, Mr. Momo. Thank you for joining us on the program.
Good morning.
It's been 4 straight sessions of gains. What would you say is really responsible for these bullish sentiments we're seeing in the market?
Basically, what we have seen lately is because in anticipation of the financial reports coming in, so people are beginning to, at least from the ones we've seen so far, they've been positive. At least most results come out are more 25% positive than what people anticipated as they were going to be down due to the COVID-19 effects that have been happening lately. But on Monday, I did write a report that markets need to see a good trading setup, and which that was on Monday. Hello. Yeah, markets.
Hello.
I did write that on Monday, market was in a good trading sector because towards the end of July, we were beginning to see the bulls coming up and slightly bearish sentiment. With what is happening now, we expect that it's still very dicey, but if everything looks good, we hope to hit at least 25,000 points. And if it fails, we might go back to about 20,000 points. So it's still a double-edged sword, either up or down, but for now, things are still looking good, especially when we're waiting for the big names like the Zenith, GTB shares, UBA financial reports, then we'll be able to move to the next level. But for now, it's still more about cautious trading. You need to be cautious in what we are doing.
All right, Mr. Momo, thank you for your input on the program. Abdurrashid Momo is a stockbroker at TRW Stockbroker. We'll have to leave it there for now. Over to you, BC.
All right, we'll just hope that the market continues its bullish trend. We'll find out in a couple of hours. But we'll do an opening call to London and the debt and currencies markets in just a moment. Please stay with us. Juliana Olayinka joins us from our London studio for this morning's major business headlines in the UK. Good morning, Juliana. Well, the Bank of England has spoken and warns unemployment is on track to rise sharply by the end of the year. But how dire is this warning compared to the previous ones?
Good morning, Bissy. Pretty dire, but no major changes, which is what was expected. The Bank of England refrained from any new policy stimulus, and the 9-strong Monetary Policy Committee members voted unanimously to keep interest rates at that record low of 0.1%. they have kind of changed their forecast of how they think Britain will recover. Back in May, I believe they thought, or they projected, that GDP in the UK would fall by about 13%. They've reduced that to about 9%. But I suppose a kind of worrying sign is that they think the recovery is going to take much longer. We have seen with the PMI figures, which have a really good forensic look at the private sector, focusing on construction, manufacturing and services, that there has been an increase. But the fact that during lockdown, Britain's GDP contracted by 20%, it is going to take some time. So even though we are seeing some bounce back, the bounce back is not strong enough. So rather than that kind of V-shaped recovery that we've been speaking about a lot on this programme, we're kind of looking at a U-shape. You spoke about unemployment. Unemployment at the moment stands at about 3.9%. The Bank of England expects unemployment to rise by up to 7.5%, which is double what it is now. There are some quite alarming headlines coming out in British media saying 1 million people could potentially lose their jobs. And really, that's what the forecast is suggesting to us. But the OBR, the Office for Budget Responsibility, which is an independent body that the government have put in place to kind of have a forensic look at the economy, their projections are much more worse than what the Bank of England are suggesting. So, for example, they predict that the economy will contract by about 12.5% this year. They've put unemployment at much higher than 10%. But we'll just have to wait and see. It's very much a wait and see game. We weren't expecting interest rates to go any lower. And that's really because over the past week or so, all Britain's biggest banks have been reporting their first half year earnings, and the earnings haven't been great. And one of the reasons why they haven't been great is because interest rates are so low at the moment. So bank profitability just isn't there. But then also, of course, we know that the government have spent billions on trying to keep people afloat, giving people certain loans so they can keep their businesses running. The Bank of England suggests that many of these loans are going to be bad debt. They won't get this money back. Many of these loans are also likely to be fraudulent. So credit impairment has been on the increase. So even though whether or not the Bank of England will take interest rates into negative territory is still up for discussion, but it just hasn't been part of the statement now.
But then, Juliana, the bank's forecasters predict that UK inflation will fall closer to zero this year. What will that mean for the policy rate environment?
Well, again, we're not sure. What we expect, or what the Bank of England expects, is for inflation to be at about 2%. It hasn't been there for a very long time. Of course, COVID has knocked everything out of the park. We did see a slight increase in June. I believe in June, inflation came in at 0.6%, up from 0.5% in May. Because lockdown has been lifted in various sectors, we are likely to see an upward trend in that, but nothing as swift as the Bank of England would like. One of the key issues we have is retail sector. The volatile markets like computer games and petrol, they've been rising and falling. If there's a new computer game, then it's going to lift the prices up, and that does have an impact on inflation. But typically, we would be seeing some of the sales from retail simmering off, but that's not the case. Retail stores are desperate to get all of their clothes off their market, so they're keeping their prices at record lows. Of course, as well, we've got the Eat Out to Help Out at the moment, which is the government scheme really trying to keep the hospitality industry afloat here in Britain. And that's given people huge discounts. That's keeping prices low. Hotels have been closed, many of them for weeks on end. Some of them have been closed for 3 months. That's also part of the downward trend. So yes, the Bank of England did reference inflation. They don't see inflation rising significantly to that 2% anytime in the near future, but perhaps at the start of 2022.
Now, how are the markets receiving the BOE's warnings this morning?
Not great, although we had predicted that it would be a wait and see and there wouldn't be much of a change from the Bank of England. It's still kind of cast a gloomy update to what we're expecting out of Britain's GDP, especially because Andy Horden, one of the chief economists here in Britain, an MPC policy member, has been speaking quite publicly, saying that he's been having a look at the data. He thinks that Britain is already on a V-shaped recovery, but clearly it isn't. So the markets, even though they weren't expecting any changes, the FTSE did open on a downward beat at the moment. And hopefully, who knows, that intraday could pick up. We are starting to get some more PMI data, and we will be getting some other data at the end of next week. But at the moment, the FTSE is in negative territory, Bissy.
All right, Juliana, we'll see you again at 1:30. Well, let's get back to Eddie Young for a review of the debt and currencies market. Over to you, Eddie.
Thanks, BC. At the fixed income market, trading at the bond market was bearish as average yields increased by 53 basis points. Now, across the curve, average yields expanded at the short and long end as investors sold off on the January 2026 maturity. Yield was flat at the mid segments, but then on that counter, we had 17 deals worth 7.76 billion naira. Average yields across the curve on the Nigerian Treasury bills market declined by 1 basis point yesterday. Now, we saw buying interest on the 11th of February 2021 maturity. We had just 12 deals worth 8.98 million naira on that counter. The automobiles market closed negative yesterday as yields increased by 22 basis points. Now, increases were seen across the short, mid, and long-term maturities. There were 43 deals worth 249.23 billion naira. But let's talk to Chukwudi Nwaokeke, the chief dealer at FSDH Merchant Bank, for more. Good morning, Chukwudi. Thank you for joining us on the program.
Good morning. Thanks for having me.
Why the sudden change in the bond market? I mean, we've seen that market bullish for a while now, but then lately there's been some bearish sentiment. Why is that happening?
Well, basically due to certain factors, we've seen liquidity drop from a high of between 800 billion to 1 trillion in the last week to close at 195 billion yesterday. We also saw yields in the bonds market drop to the lowest levels that we had seen in a long time. And that led to some profit taking by players in the market.
What would you say you're expecting from trading today? What's your outlook for today's trading?
Well, for trading, this week has generally been very quiet on the fixed income tables, T-bills and bonds. We've seen yields on T-bills at low levels as well as the bonds. For the T-bills, we've seen rates drop sharply last week due to the high liquidity, as I mentioned before. However, as CBN debited for FX retail, auction, and TRR, we saw rates rise marginally. The market has been very quiet. We expect that quietness to persist today, but we expect some activity going into the next week with almost maturity of about 88 billion coming in. And the improvement in the liquidity levels going into the next week should ginger the market and lead some demand in the market.
Thank you, Chukwudi, for your input on the program. Chukwudi Nwaokeke is the chief dealer at FSDH Merchant Bank. Let's quickly look at the unlisted securities market. Investors decided to book profit on that segment of the market yesterday as the NSI declined by 0.48% to 702.08 points. And that's after gaining by about 0.88% yesterday. The market cap fell to 515.72 billion naira. There was a lot of activity on that segment yesterday. We saw 1.29 million units worth 7.08 million naira traded in 9 deals. But we'll have to stop here for now. We hope for a profitable trading day, as you would always say, BC.
As always, Eddie Young. And that's where we end today's program. Thank you for watching. I am BC Adebayo. See you tomorrow.